Politics and economics are decuminate. US stocks and FX are decuminate.
Let's unpack this. The world is definitely in the midst of an AI revolution. And, while we hear a lot about the algorithms, the powerful chips, there's this massive energy-intensive backbone making it all work, the data centers. So today, we're taking a deep dive into Applied Digital, ticker APLD. This is a company that's gone through a really dramatic transformation to become, a key player in this critical infrastructure. We've got a stack of fascinating sources you sent over financial reports, analyst insights, some in-depth interviews with their CEO, Wes Cummins, and these really comprehensive industry analyses on data center power needs, our mission. To pull out the most important nuggets, understand APLD's strategic moves, and see how they fit into this bigger picture, this AI gold rush. Expect some surprising facts and crucial context along the way. Now, the CEO of Applied Digital, Wes Cummins, he made this powerful statement that really caught our attention. He called the current AI gold rush the internet build-out in the late 90s and early 2000s on steroids. But he added a crucial difference. It's much, much faster and entirely power-driven. That comparison, it's not just hyperbole, is it? It really signals a fundamental, incredibly rapid shift.
Yeah. It's absolutely spot on. The scale of investment here, it's just staggering. We're talking about giants like Microsoft, Amazon Web Services. They're pouring unbelievable amounts of capital into data center expansion. Our sources are indicating Microsoft is planning something like $80 billion in data center spending for 2025.
$80 billion for 1 year.
Yep. And AWS is looking at maybe $60 billion for the same year. And to put that into perspective, Cummins pointed out that just those two companies, they're planning to spend as much as the entire data center market did only 4 years ago.
Wow.
Yeah. So when demand explodes like this, you get massive bottlenecks. Initially, back in 2023, early 2024, the big constraint was getting enough GPUs. Now the question is shifted. It's more fundamental. Where do I actually put those GPUs?
Right. It's not just the chips anymore.
Exactly. It's land, permits, building the physical structures, getting all the specialized equipment inside, which often have incredibly long lead times. And underlying absolutely everything is power. Without enough power, those GPUs are just, very expensive paperweights.
So when everyone's scrambling for power in that physical space, it really sounds like a massive opportunity for companies providing that underlying infrastructure. The picks and shovels for this AI gold rush. But is it really that simple? Or could APLD and others like them actually get caught in the same supply chain crunch that's hitting everyone?
That's a critical question. It is definitely a huge opportunity, but execution is absolutely key. And that's where APLD's strategic pivot becomes really, really interesting.
Right, because Applied Digital wasn't always doing exactly this. They've made a significant shift. So how exactly are they positioning themselves to capitalize on this intense demand while hopefully avoiding those bottlenecks we just talked about?
Yeah, to really get APLD's current position, it helps to look back a bit. They actually started back in 2020 as Applied Blockchain. Their main focus then was hosting for Bitcoin miners.
Okay, crypto hosting.
Right. But by 2022, they strategically rebranded to Applied Digital. And they shifted their core focus to designing, building, and operating these next-generation data centers, specifically for high-performance computing, HPC, and AI applications. Now, their approach to dealing with that power bottleneck is particularly insightful. They focused on what they call stranded power in North America.
Stranded power. What exactly is that?
Think of it as finding, untapped or underutilized electricity. Maybe where old industries shut down, or places where renewable energy production just outstrips the local demand. A prime example they give is the huge 2-gigawatt wind farm surrounding their Ellendale campus up in North Dakota.
Okay. So tapping into existing, maybe overlooked resources.
Exactly. That location offers electricity about 20% cheaper than the national average, tons of renewables, and it's naturally cold, which helps with cooling efficiency. And crucially, they were proactive. They secured this power before the AI boom really kicked into high gear. Yes. And that foresight helps them cut typical build times significantly, from maybe 24 months down to just 12 or 14 months. It's a huge competitive advantage when things are moving this fast.
And it's not just about location, right? Their technology is also a big part of this story. Our sources are saying that liquid cooling at scale is going to be, quote, one of the biggest stories of 2025. Applied Digital seems to be right at the forefront here with what they call waterless liquid-to-liquid cooling at that Ellendale facility. They're achieving an impressive 1.18 PUE power usage effectiveness. I mean, we're talking about machines running so incredibly hot. It's like trying to cool a blast furnace with a small desk fan, right? So traditional air cooling just can't cope.
Is this tech truly a game changer, or are there complexities, maybe trade-offs, that listeners should know about?
It's definitely a game changer, but it's one born out of sheer necessity. NVIDIA's latest GPUs, like their Blackwell chip, they're so power dense, they consume over 120 kilowatts per rack.
Per rack. Wow. Yes, and they generate tremendous heat. Traditional air-cooled data centers, they simply cannot manage that kind of density. Now, while the Blackwell chips use more raw power, the CEO did highlight they offer about 3 times the compute per watt. So they are actually more efficient overall.
Okay, so more power, but much more efficient use of that power.
Precisely. And APLD's direct-to-chip liquid cooling is specifically optimized for these advanced NVIDIA GPUs. This significantly boosts cooling efficiency. They project savings of maybe $2.7 billion over 30 years for a single 100 megawatt customer.
$2.7 billion, that's huge.
It is. That's compared to traditional designs. And remember, 100 megawatts is enough power for a small city. Beyond the tech, their strategic partnerships are also absolutely critical. They've locked in a major 15-year lease with CoreWeave. That's one of the big AI-focused hyperscalers.
Right, CoreWeave. Heard a lot about them.
The lease is for 250 megawatts, with an option for another one for 50. If that option gets fully exercised, it could bring the total contracted revenue to somewhere between $7 billion and $11 billion over the full term.
That's massive long-term visibility.
It is. And they've also secured substantial funding commitments, up to $5 billion from Macquarie Asset Management for general data center development, plus $900 million specifically for that Ellendale campus, and another $375 million financing deal from Sumitomo Mitsui Banking Corporation.
Okay, so the big financial institutions seem confident.
It definitely reflects strong confidence in the value of their assets and their pipeline. They're even breaking ground next month on a new $3 billion campus, Polaris Forge 2, also in North Dakota. It's planned as a 280 megawatt AI factory, with initial operations expected in 2026. And one more point the CEO emphasized. While everyone focuses on NVIDIA's chips, NVIDIA's real competitive advantage, their moat, is the entire system. The GPU, the networking, the software like CUD, is much harder to replicate that whole package.
And Applied Digital's role is crucial in actually deploying that whole integrated system effectively.
Exactly. They provide the critical environment for it to run.
Okay, so APLD seems to have a lot of key pieces falling into place. Strategic location, cutting-edge tech, these huge partnerships. But are they building a sustainable fortress here, or maybe more like a house of cards? Let's turn to the financials, because for all this impressive growth, our sources paint a picture of a company walking a very, very tightrope between ambition and profitability. What does this financial tightrope actually look like on the ground?
Well, it's a classic high-growth dilemma, especially in a sector this capital-intensive. If you look at Applied Digital's fiscal third quarter 2025 results that ended February 28th, 2025, revenues were up a solid 22% year-over-year, came in at $52.9 million. That growth was driven by their cloud services expansion, and notably, adjusted EBITDA actually turned positive.
Okay, positive adjusted EBITDA, that's a good sign operationally.
Yes, it hit $10 million compared to a loss of $1.3 million the previous year. So, definite improvement there.
But, and this is a big but, our sources also show that the net loss attributable to common stockholders actually increased. It went up 43% to $36.1 million. That kind of feels like they're running faster just to stay in the same place, doesn't it? Or even falling behind slightly on the bottom line?
Precisely. That increasing net loss, even with growing revenue, clearly shows just how capital-intensive building these next-gen data centers is. It demands massive upfront investment, leading to continued cash burn. The core insight here for you, the listener, is that growth in this sector isn't just about sales. It's about constantly feeding a beast that eats capital, potentially faster than it generates profit. That's a critical tension to watch. And adding another layer, the company recently announced plans to sell its cloud services business.
Ah, okay. Why?
The goal seems to be focusing entirely on the data center operations side. Partly, this could facilitate a potential future transition into a data center REIT, a real estate investment trust. That would definitely change their financial structure.
So let's look at investor sentiment. On one hand, analyst sentiment seems largely positive. Market Beat shows a consensus buy rating from, 13 Wall Street analysts? And the average price targets have climbed over the last year, from around $8.40 to $15.64 now, with some analysts even targeting $23. But then you also see considerable, let's call it chatter, on social media expressing caution, people noting the speculative nature of the stock, and a really high short interest, around 30% of shares last I checked. That's significant. What's driving that skepticism? And are there other warning signs in the financials we should flag?
That contrast is really a key takeaway for anyone looking at APLD. You have the institutional support, the rising analyst targets. That's the bull case. But that high short interest, that signals significant market skepticism, people betting against the company, often fueled by worries about valuation or maybe unaddressed risks. And critically, looking at insider trading over the last 6 months, the activity shows multiple significant sales by executives.
Selling shares.
Yes, selling shares, with no corresponding purchases. That's a trend that often raises red flags for investors, fairly or unfairly. Hedge fund activity is also mixed. You see some big additions, like BNP Paribas adding over 5 million shares, but then others, like Oasis Management, substantially cut their position, removing about 7.7 million shares. So it really underscores this divided opinion on APLD's risk versus reward right now.
Okay, beyond those specific warning signs, what are the bigger, maybe systemic risks for Applied Digital in this really volatile, capital-heavy market? What could truly derail their ambitious plans?
Well, looking at the wider industry picture, the primary risks really circle back to that capital intensity. Just the sheer cost of construction raises constant questions about funding and, importantly, execution. Can they deliver on time, on budget? Especially given the ongoing cash burn. Value the Market specifically highlighted this concern. Then there's a significant risk that the hyperscalers themselves, the Googles, Microsofts, Amazons, who have just vast resources, might choose to build more of their own infrastructure.
Instead of leasing from companies like APLD.
Exactly. Our sources mentioned Microsoft actually canceling some existing data center leases recently. That underscores this very real threat. Those multi-billion-dollar contracts look great, but they can be vulnerable if these tech giants decide to do it themselves, as one source put it. Build their own chips, software, and the data centers.
Like vertical integration.
And finally, just successfully executing these massive projects is a continuous, monumental hurdle.
Yeah.
On time, within budget. Especially when you factor in global supply chain challenges for critical gear like generators, switchgear, chillers.
These aren't small bumps in the road.
Not at all. These are significant challenges for any company in such a high-growth, capital-intensive race.
Okay, let's zoom out a bit. This massive build-out for AI. It isn't just about APLD's balance sheet. It has profound implications for our power grids, for our environment. We're building this amazing AI future, but what's the cost in terms of energy and water?
It's a really critical balancing act. This AI boom isn't just reshaping technology, it's profoundly impacting our whole energy landscape. Data centers right now account for about 4.5% of total U.S. electricity consumption.
4.5% already.
And the Lawrence Berkeley National Lab projects this could surge, potentially to between 6.7% and maybe even 12% by 2028.
Doubling or nearly tripling in just a few years.
Potentially, yes. This rapid increase poses two significant threats. One, utilities might have to resort to more gas or even coal-fired generation just to meet that sudden demand. And two, it makes achieving state and utility clean energy goals much, much harder. We're seeing utilities getting requests for new data centers needing over 1,000 megawatts.
1,000 megawatts? That's like a nuclear power plant for one facility.
Sometimes these requests are for 50% of the utility's entire current system peak demand.
Right.
So this raises a really important question for society. Who should actually bear the costs? Should growth pay for growth?
Meaning, should the data centers pay for the new power plants and transmission lines they require?
Exactly. Utilities are developing new contract models to ensure that happens. Things like Indiana and Michigan Power's 12-year commitments with minimum charges. Arizona Public Service has new guiding principles too. The idea is to make sure these large data centers pay for the new infrastructure they necessitate, without burdening other residential or business customers. Many states are also looking at legislation to mandate this. Plus, potentially requiring 100% renewable or net zero carbon electricity purchases for these large data centers. And interestingly, there's a strong recommendation against offering financial subsidies or tax credits to these already highly profitable tech companies. The argument is those incentives should go to businesses creating more long-term local jobs.
Okay, so it's clear the infrastructure has to play catch-up and do it sustainably. The PUE and WE numbers you mentioned really bring that efficiency challenge into focus. We know PUE, power usage effectiveness, lower is better for energy, and WE, water usage effectiveness, lower is better for water. How are companies, including APLD, tackling these environmental and efficiency challenges in practice?
You really hit on a key point. Efficiency is absolutely paramount now. Utilities are exploring things like demand response programs, incentivizing data centers to shift their power usage to off-peak hours, and there are successful energy efficiency programs focusing on cooling systems in UPS, the uninterruptible power supplies. Now, while average PUEs across the industry are generally decreasing, which is good, it means better energy efficiency. Our sources highlight this crucial paradox. Average WUEs, the water usage, are actually increasing in some areas.
Increasing? Why?
Because some of these advanced liquid cooling systems, while very energy efficient, still rely on traditional water-intensive chillers for supplemental cooling. So there's often a trade-off between saving energy and saving water.
Ah, okay. An unintended consequence.
Potentially. Now, APLD's 1.18 PUE at Ellendale, that's very strong. It minimizes energy waste. And their waterless liquid-to-liquid approach, which is enabled by North Dakota's cold climate, specifically aims to tackle that water consumption challenge by reducing or even eliminating reliance on water evaporation for cooling.
So leveraging the local climate.
See, exactly. This approach aligns with best practices we're seeing from industry leaders. Google, for instance, boasts an average PUE around 1.10 across its fleet. Microsoft is piloting zero-water evaporated designs and committing its new data center designs to next-gen cooling tech that recycles water in closed loops. Companies are also increasingly using alternative water sources, like reclaimed or recycled water. This whole push for efficiency and sustainable cooling, it's not just good for the planet, it's absolutely crucial for controlling operational costs in this incredibly power-hungry industry.
Wow. What a fascinating deep dive this has been. We've really seen Applied Digital's remarkable journey, haven't we? From a crypto host to becoming this potentially critical player in AI infrastructure, securing massive contracts, big investments, leveraging strategic locations, and that advanced cooling tech. Yet, we've also unpacked that financial tightrope they're walking, that tension between rapid growth and achieving sustained profitability. And we looked at the broader challenges the entire data center industry faces with power, sustainability, and just responsible growth overall. It's definitely a compelling story of huge ambition and significant risk in a truly transformative sector.
Absolutely. And if we connect all of this back to the bigger picture, it really leaves us with a truly thought-provoking question for you, the listener, to consider. As AI becomes more and more central to our lives, our economy, everything, what does it really mean for society when such critical, energy-hungry infrastructure becomes so concentrated, so centralized? Who should ultimately control the picks and shovels of this AI gold rush? And perhaps more importantly, what influence will that control exert on the future of technology and ultimately on society itself?